Good morning, everyone. It is May 6th, 6 a.m., half an hour before the market's going to open, and it's the start to our first full week in May. So normally that means that we've got some really active trading that will happen. Anything that wasn't done on last week would start to get done today or this week. However, also at the beginning of the week, we tend to have rebalancing and repositioning for portfolios, removing of hedges over the weekend, or any sort of other balancing that needs to happen for what is expected for the upcoming week. Monday tends to chop sideways, maybe go down a little bit. And then in the second half of Tuesday, that's when we see rises in markets seasonally, normally. Let's see how everything is looking and how that fits into the overall picture that we talked about in the weekly market review yesterday. So let me turn that off. Okay. So our futures. We'll start with our futures. Futures are up. Looks like somewhat significantly. If we look at the S&P 500, that's about 40 basis points. The NASDAQ is about 30, 33. So about one third. And then the Dow Jones is at about 40 basis points. Normally, we would call that just a hair beyond random. Today, I'm going to call that random because we are in a heightened volatility environment, not as measured by VIX, because VIX would tell you otherwise. VIX, we're kind of lower. We're actually at the normal for 2024. But at least in terms of price movement. So I look at the S&P, not in terms of the size of the bar, not just in certain terms of the size of the bar, but in terms of the gaps. If I include gaps and size of the bars in my analysis, then those are pretty large moves that we're seeing here. And that is reflected right here in what we call the ATR. So you can see that this ATR is moving higher. We're currently in the S&P 500 at 6.5. It has gone higher before, but that's 2020, which is COVID period. So really, it's pretty high historically. The only time in recent times where it's been higher is over here in 2022. So we're at reasonably high levels of the VIX, or the daily volatility or daily range of movement, including gaps. We're in a heightened environment in terms of volatility. And for that reason, I'm giving it a little bit wider berth before I call it non-random. So definitely an upward bias in the markets. In the weekly market review, we talked about how we are right at the edge of the MA50 right here. And if we got comfortably above the MA50, then we would trigger some short covering. And if we get short covering, then we're probably going to move higher up to the 517 to 520 region. And then if we can continue to move higher, then we'll challenge all-time highs. And for now, that's probably about it. As far as we can see in terms of movement, it doesn't seem too likely that we'll be able to break out of all-time highs just yet. If we are going to break the all-time highs, then we probably pull back first and then move higher. It's unlikely that we're going to just power through and make all-time highs. Now, I could be wrong because this has been a really strong upward movement, and we could resume that strong upward movement. There's also news that came out over the weekend. So Apple reported earnings just before the weekend. We did it on Thursday evening, I believe. Yes, Thursday evening. So the market had Friday to react to it. And really, the main news is not that they had these earnings surprises, but hidden inside of that news was that iPad sales were down 10% globally, which is pretty significant. And that it would normally have been very negative news and probably would have sent Apple even lower. But Apple went even higher. They gapped up instead of gapped down because Apple also announced a $110 billion buyback, which is the largest in history in any company ever, because Apple is also one of the largest market cap companies ever. So there's not that many companies that could announce a $110 billion buyback and still have significant shares floating around in the market. So this is the largest stock buyback announcement in history. And that news, which means that Apple has demand for its own stocks. So now we know that there's someone to sell to. So now we know that someone wants shares, demand is up, that's why prices are up. Over the weekend, we found out that, I don't know if it was directly related to this news, but probably, I wouldn't be surprised, that Warren Buffett started to shrink his position in Apple, most likely because of this share buyback. And the person in Berkshire Hathaway who was really pro Apple and started collecting these shares in Apple to begin with was Charlie Munger. So now that Charlie Munger isn't around, and to overwatch the Apple position, and that Apple has announced this huge buyback, Warren Buffett is starting to let go of shares. So we'll see what happens. On balance, is still probably go up because there is a huge buyer in the market. So this could start sending Apple upwards, which would be a boon to the S&P 500. So this, normally we say, hey, news only a couple of days at max in terms of their impact on the markets. However, because Apple's buyback 110 billion, it's not going to be a 1 or 2 day event. It's probably going to take at least a couple of months for that buyback to be completed. And I would say probably many months for that buyback to be completed. So that could have a lasting effect on Apple for a little while. And if, as one of the largest market cap stocks in the S&P 500 and in the world period, then that could have a lasting effect on markets. So that could be the catalyst that we were looking for. When we said last week that earnings and the FOMC and everything that we had heard so far was the catalyst that got us up to the MA50, but we didn't have a catalyst to get beyond the MA50. And this could be the lasting effects of this Apple buyback could be the catalyst that sends us above the MA50. And it looks like we're above the MA50 in the pre-market. We'll take a look at that in just a moment. So given that we have Warren Buffett selling shares in Apple, another interesting effect happens. Buffett's going to have a whole bunch of cash. And he's probably not going to sit on that cash for a super long time. And the question is, where does that cash get deployed? Does it get deployed into the US markets? Does it get deployed in Japan, like he had been doing earlier this year or last year, late last year? Or does it get deployed somewhere else? If it gets deployed in the US, which seems like it's probably pretty likely, then that would be an upward moving force for the market as well. So those two things combined start to give us a slightly more bullish bias than we had before. Before we say chop, 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 a wider chop between the all-time highs and the this 475 level up until elections, before we have the major catalyst that sends us up. And now it's the fact that there's a huge investor in the market who's going to have a whole bunch of cash, and that there is at least rumor, I still haven't been able to verify, rumor of a lot of uninvested cash for the US markets, then that once that cash gets deployed could be the catalyst to move upwards. But it doesn't have to be immediate. Yes, hedge fund managers are incentivized to put that capital to work so that they can potentially make money, and then they can grow their ability to make large bonuses. However, they also get hurt if their performance is not so good. So if they take risk and they lose money, then that will shrink their bonuses. So what do fund managers tend to do? They wait for risk to clear, or until they get a clearer picture when they see that a risk has potential of shrinking, or they have an edge on the risk, meaning that yes, there's heightened risk there, which means actually heightened opportunity, a lot more movement for prices, or a lot more room for prices to move. And then if I have an edge on top of that, meaning that I have a bias, I have an ability to put the odds in my favor or more in my favor than normal, then that is when we start to deploy capital. There's a big event that's coming up in the United States that will affect the United States markets that we probably want to wait for so that we have higher certainty in market direction, or at the very least sector direction, and that's the elections. So if I'm a portfolio manager sitting on hundreds of millions of dollars, I might deploy that slowly over the summer, but I'm really going to wait for the bulk of it for those elections. I don't want to make huge bets before the elections. Now remember, what is a time horizon for a normal portfolio manager? That is normally, it depends on what type of portfolio. If I am a insurance company or a retirement fund company, I have mandates, I have laws that dictate the length of my investments, and their time frame tends to be longer, minimum 2 years. So I definitely would want to know what the next president is going to be if I'm going to deploy capital, because my capital timeline is definitely within that president's term. So I'm going to be waiting because I have to wait a long time. Once I go into position, I have to take a long-term view of it, and I can't just trade in and out of these positions. One, because of the size that I'm deploying, but two, because I actually have mandates that prevent me from trading in and out. If I'm a normal prop firm trader, if I'm doing proprietary money, or I'm doing hedge fund money, if I'm doing any sort of total return type of portfolio, then my time frame is very likely between 1 and 3 months. Sometimes 6 months, that's a little long for a total return portfolio, but I'm looking at 1 to 3 months. So if I'm looking at 1 to 3 months, I can deploy capital before the elections, because even 3 months from now would be August. That's before the elections. So I'm still pretty active. But there is a huge amount of money in mutual funds, retirement funds, and insurance funds that is not allowed to be that nimble. And therefore, those money, that's actually the largest institutional pocket of money, is the retirement and insurance funds. So they will be waiting for the elections. So there is a lot of money. If there is cash out there, it's waiting for the elections. So we don't necessarily see that everything that we talked about in terms of Berkshire Hathaway and Apple and all this cash that's sitting on the sideline. Yes, that is going to be a catalyst to the bull side, but it doesn't necessarily trigger for a few months. So we'll just be aware of that. Now we have this pre-market open because we have the futures move up. We're at 513.3. The MA50 is at 511.54. We closed last week at 511.29. And that means we are above our MA50 right now. Are we far enough above it to trigger short covering? That depends on who had the shorts on. Retail traders, maybe, if they stuck it right at the MA50, the normal behavior and the normal, I guess, advised behavior, if you're a more sophisticated trader, I'll say it that way, is that you would put your stop at least one ATR above whatever your resistance level is. So if I'm at 511.54 and I've got an ATR of 6.5, well, most people are not using a 10, they're probably using a 14. So 6.3 plus 511.5, we'll call that 517.8. So we're not necessarily going to trigger a whole bunch of short covering until we hit that 517 level, which is, what did I say earlier? I'm not sure if I said earlier today, but for sure I said it earlier for the last several sessions, is that if we break above the MA50, we're probably going to 517, or this 516.75 to 518 region. Okay, that's perfectly up to 1 ATR above the MA50. And then if we break that, that's when we have a whole bunch of short covering, and we'll have short covering in between the MA50 and the 517 level, but we'll have a whole bunch of short covering if we break above that 517 level. And then that has the possibility of surging up into the next region. So when we see that short covering, we tend not to have massive runs when we're talking about a large index like the S&P 500, but we will have gaps, and we might hit, for example, if we hit that 517, just say today, and then tomorrow we break above the 517, then we might just simply gap all the way up to 525 and start trading at 525. We will skip an entire region of prices, but we will still honor the next strong level of resistance. So that's what runs tend to look like in the S&P 500, like this big gap right here, this big gap right here. That's what they tend to look like in a major index. It's not like GameStop, where not like this. I'm surprised that ended up being a great example, but that's not the example I was thinking of. I was thinking of this one over here. So this is what short covering can look like in a small cap stock or a meme stock. But in an index, it doesn't look like that. There's just simply, it's too big and there's too many stocks involved. So we just get these gap ups like this. So we have the potential to, if we break above that 517 to 518 region, to simply gap up to in the mid 520s. So we want to be aware of that. Obviously, we don't want to be super short or necessarily even leaning short in a portfolio at this particular point in time. If anything, we would want to be neutral or slightly bullish at the moment. And so we need to start making adjustments in our portfolios if we are bearish. So a quick way of doing that is a hedge. If we don't have enough time to get ourselves into position, then we would just do a market hedge. SPY, QQQ. QQQ, same story. We're right at that MA50 pre-market. We're just above the MA50. There's probably more shorts in the QQQ than there are in the S&P 500 because tech stocks are more speculative. People will tend to short or make speculative types of investments, or if you're a retail trader, gambles on the riskier or the more volatile type of stocks. And so there's probably more shorts in the QQQ than there are in the S&P 500. So it has an even more or even higher potential of gapping if we break through all of the shorts. Let's take a quick look. It's already 6:20. The last thing I'm going to look at is VIX and dollar. I just want to get a bigger picture view of everything. VIX is down. We already looked at this actually earlier in the normal region for 2024. There's no significant movement so far this morning. So, but what is interesting is that futures are up, and it looks like we're hitting, or we're going to open above that MA50, but my VIX is slightly elevated rather than down. So we do see some potential for a lot of price movement. So far muted. Not, I wouldn't read too much into this, but we would just be aware that at least the market makers are starting to look at this market as if prices could move even more than they have been, which means our ATR, what they're seeing is the potential for that ATR to continue to move even higher. And then if we look at our dollar, DXY, dollar broke through this trend line that we drew. It was just chopping sideways. Now it's definitively down. So it's going to be important to see how the price moves from here. Do we bounce and resume this trend? In which case that is a strong dollar, not great for stocks. But if our dollar continues to weaken, then our stocks would be would be stimulated by a weaker dollar, and so would bonds, and so would gold, and so would oil. So we'll just keep an eye on this because it'll be an important indicator for several different markets. Okay, so we're pretty close to market open. We'll leave it there. We've got a good picture of what to expect for the SPY. Today is Monday, so we won't be too surprised if we don't get that trigger. Now, if we just hang out in this 514, 516, 517 region and not actually break out and trigger a massive amount of short covering, but we'll want to watch the levels very carefully. This 516 to 518 region, and then this 510 to 512 region. If we move beyond those levels, then we can get really directional. But today, Monday, normally a rotational or rebalancing type of day. So most likely we'll stay within those regions and chop sideways. That's it for this morning. I'll leave you guys to prepare for the open, and I will see you in the aftermarket.